Here we are in the last section of our module on input tax credit. We'll check out the provisions, specific provisions relating to job worker, principal and job worker. We'll also look into input service distributor. We'll pass through the distribution rules and understand the manner and conditions for distribution of credit. Let's start off with job worker and principal. Who's a principal and who's a job worker? A principal is a registered taxpayer. He definitely has to be registered because that's the first condition for claiming input tax credit. He's a registered taxpayer who wants to get his work done by a job worker, for which he'll send out goods to the job worker. The job worker would process the goods for the principal. There's a movement of goods. The principal will have to send goods to job worker, and on this goods that the principal sends to the job worker, he does not pay any tax before supplying it to the job worker. So this situation is similar to exempt outward supply. Remember how we treated exempt outward supply? All the inputs that go into exempt supply, there is no input tax credit available. So would there be input tax credit available for this situation for the principal? Well, yes. You could treat this as an exception to the general rule related to exempt outward supply. Goods sent to job worker, input tax credit is available, but of course there's a condition attached. No input tax credit comes without any condition. So, there's inputs that the principal buys from his supplier, purchases. He'll pay some tax on such inputs. He'll send these inputs to the job worker without paying any tax. So we are dealing with a situation where the principal can claim input tax credit on the tax he paid on the purchases. These inputs can be of two types. It could be either inputs, the raw materials that go directly into production, or they could be capital goods. We've seen the definition of both these earlier. There could be two ways in which the job worker receives these goods. It is sent from the principal's place of business, or it could be sent directly. In both these situations, input tax credit is allowed, and the conditions for both these are the same. What are these conditions? The principal should either receive these goods back from the job worker, or he should have supplied it, sold it from the job worker's place of business as per certain terms and conditions within a fixed period of time. So this is the condition. The principal should have either received the goods back or he should have sold it from the job worker's premises as per certain terms and conditions within a stipulated period of time. There's an exception. We'll check each of these line items. The first that you'll need to know are the terms attached for sale directly from the job worker's place of business. The principal can effect this sale and claim input tax credit on the input if he declares the job worker's place of business as his additional place of business, unless the job worker is registered or the principal is engaged in supply of goods which are notified by the commissioner specifically. He'll have to send out goods from the job worker's place, sell it after paying tax if he's selling it within India. If he's exporting, then he can send it out with or without paying tax. These conditions are very logical. They actually fall very much in line with the three reasons we discussed while talking about overall conditions relating to input tax credit. They fall within the first reason, where the government should be able to track, should be able to maintain audit trail to identify the correctness of the claim. If the supplier sells goods from the job worker's place, the government would want to track it. If the job worker is registered, it is very easy to track. But if he's not registered, then the government would want to track it via principal's returns. So principal has to declare this place as the additional place of business, and that makes it easy for the government to track. So those were the terms attached to sale directly from the job worker's place. The second is the stipulated period of time. What's the timeline? For inputs, it is within 1 year from the date goods were sent out or received by the job worker. There are two situations for sent out and received. We'll talk about it in a bit. For capital goods, this timeline is within 3 years. So, the principal should get back his inputs within 1 year, get back his capital goods within 3 years, or make sale within 1 or 3 years respectively. Remember the two situations how the job worker gets goods? If these goods are sent from principal's place of business, then this 1 year would be computed from the date that the goods were sent out from the place of business. If he gets it directly from the principal supplier, then the date would be 1 year or 3 years from the date the goods were received by the job worker. What is the exception? Simple one. This is an exception related to molds and dies, jigs and fixtures, and tools. If these are sent by the principal to the job worker, then there are no conditions attached. He can very well go ahead and claim input tax credit. He need not receive these goods back. It's not possible also to receive these goods back. They would wear and tear within 3 years. They are basic manufacturing equipments. So, if all these conditions are not met, that the principal doesn't receive goods back or doesn't effect a sale from the job worker's place of business within 1 year or 3 years respectively for input and capital good, then his transfer of goods to the job worker is deemed as supply, deemed as sales for the principal from the date that the goods were sent out, if he is sending out from his premises, or from the date that the goods are received by the job worker if they are sent out directly from the supplier. So these would be deemed supply. He's not paid any tax while transferring these goods to the job worker. So they'll be treated as exempt outward supply. And as you know, there is no input tax credit available for exempt outward supply. So if the principal does not meet these conditions, he will have to forfeit the input tax credit claimed. He'll have to pay it back.